All right, let's jump right into this. Welcome to The Explainer, where we take complex source material and break it down into clear visual insights. Today we're unpacking a fascinating AI investment memo. We're looking at Haypp Group. They're a massive Swedish retailer completely dominating the smokeless nicotine space. I mean, they're seeing explosive top-line revenue growth and they're expanding all over the globe. But just because a company is moving a ton of product doesn't automatically mean it's a great stock to buy, right?
So that's exactly what we're stress testing today. Is the world's biggest online nicotine retailer actually a great investment? We're taking this undeniable growth story and putting it up against the uncompromising, skeptical standards of a buy-side investor. We don't want the hype, we want to know if that underlying economic engine is built to last. But to figure out where they're heading, we kind of need a quick look at how they got here.
So here's a quick look at their timeline. They started back in 2009 as a local Nordic retailer called Snusbolaget. Over the next decade, they built up a really strong e-commerce presence. Then, 2019 was a total game changer. A merger with Northerner seriously expanded their international reach, especially into the US. By 2021, they went public to fund an aggressive expansion, and now, heading into 2026, they're pouring everything into scaling up in the massive US and UK markets. It's your classic, lightning-fast growth story. But what actually is their business model?
To understand that, we've got to draw a really sharp line. Here's the deal. Haypp is a highly efficient logistics, retail, and marketing platform. What they are not is a manufacturer of the products they sell. They don't actually own the brands like Zyne or Velo. They just sit right in front of them as the middleman. And that is absolutely crucial to understand. Their entire moat relies on executing online retail better than anyone else, dominating search, nailing delivery logistics, rather than owning a highly defensible proprietary product of their own. And that brings us to a critical number, 18.5%. That was their gross margin in 2025. Now, if you're an investor, an 18.5% gross margin screams one thing loudly. This is a thin margin distribution business. They're moving massive volumes, yeah, but keeping a pretty tiny slice of the pie for themselves. With margins this tight, even the slightest bump, a tiny change in pricing, higher marketing costs, a fulfillment hiccup, can just wreck their bottom line. There is literally almost no cushion for error. But they do have a bit of a secret weapon. And that's their media and insights division. Think about it. Because Haypp processes so many online transactions, they're sitting on an absolute goldmine of consumer data. So they package this data, along with bespoke marketing services, and sell it right back to the big tobacco suppliers. This is a much higher margin service, and it makes up about 10% of their total sales. This is a brilliant move, because it actually deepens the supplier's dependence on them, giving Haypp a real edge against the massive offline retail giants. But, and there's always a but, this brings us to the core dilemma of our analysis: growth versus margin. Yes, they're absolutely crushing it when it comes to customer acquisition right now. They're adding hundreds of thousands of active customers, especially internationally. But that rapid growth, it comes at a steep and honestly pretty fragile cost. Basically, they're buying customers today and just hoping those customers become highly profitable tomorrow.
Let's look at how this actually plays out in the numbers. Looking at this breakdown, in their mature core markets, like the Nordics, they're generating a really solid positive earnings baseline. But look over at the growth markets, the US and the UK. The trend totally flips. Despite sales going through the roof, their profitability in those exact markets is sinking deeper and deeper into the red. It's a classic friction point. International sales are climbing fast, but they are absolutely burning cash to make it happen.
Even with that cash burn, management is aiming high. They've set an ambitious adjusted EBIT margin target of 5.5% by 2028. But let's be real, jumping from their current numbers to 5.5%, that requires near-flawless execution. They basically have to aggressively protect their cash cow Nordic markets while somehow stabilizing and squeezing profits out of those incredibly expensive growth markets at the exact same time.
So, what happens when we stress test this? Looking at the quality of earnings scenarios here, the bull, base, and bear paths, it's clear that even the middle-of-the-road base scenario demands a ton of heavy lifting. For this stock to justify its current premium valuation, Haypp has to perfectly navigate tightening regulations, they have to keep those brand owner suppliers completely happy so they don't get squeezed out, and they have to prove that all these new international customers are actually going to stick around. If even one of those variables slips, we tumble right into the bear scenario, where revenue might look great but earnings totally disappoint.
Which naturally leads us to look under the hood for red flags. As skeptical buy-side investors, we can't just nod along to management's rosy projections, right? We have to do a forensic dive into the financials and the corporate behavior. And honestly, when you dig into the memo's findings, you hit a few things that should definitely make you pause and ask some tough questions. Let's rapid fire through some of these financial caution signs. First up, we've got notable insider selling by the CEO in 2025. Look, executives sell stock for lots of reasons, but it definitely lowers the trust ceiling when you're asking investors to buy into a long-term vision while taking chips off the table. Second, they lean really heavily on adjusted profit metrics, stripping out legal and restructuring costs. The issue? Those supposedly non-recurring costs seem to magically pop up almost every single year. And finally, high capitalized development expenses. This basically flatters their current earnings by pushing current tech costs off into the future. These are the hidden costs of running a fast-growing retail machine.
And we haven't even talked about the external threats yet, the regulatory minefields. We're talking about a forced market exit from Austria in 2026, ongoing licensing litigation in their home base of Sweden, and tightening FDA reviews and youth access restrictions across the US and the UK. Now, we're not saying these are fatal blows that are going to bankrupt them tomorrow, but they're a constant structural friction. It stops the business from ever becoming a clean, predictable cash machine simply because the rules of the game can change literally overnight in any given country.
Which brings us right to the analyst's ultimate verdict from our source memo. They classify Haypp as, quote, closer to good business with meaningful upside than exceptional business you can own with wide margin for error. And you know what? In investing, that distinction is absolutely everything. An exceptional business, that deserves a premium risk-free valuation because it has a structural, deeply entrenched moat. A merely good business, even one growing like wildfire, requires you to be incredibly careful about the price you're willing to pay.
So, what's our big takeaway from all this? Simple. Demand proof of profitability before you pay a premium. Haypp is a fascinating company, no doubt, and it's got a killer top-line growth story. But until they can actually prove they know how to convert those super expensive US and UK customers into real bottom-line profits, and until all this regulatory dust settles, it is 100% a show-me story. So here's what you need to ask yourself. Should you ever fully trust a high-flying growth narrative before the unit economics are definitively proven? I'll let you think on that one. Thanks for joining me on this explainer, and keep questioning the numbers.